Hey, how's everybody doing? Welcome to Stock Market Unfiltered. My name's Ken. I'm a country boy. As you can see, I don't have no fancy photography and any fancy graphics. Just me talking. Now, I'm from North Carolina, 62 years old. Wiped out a couple of years ago. So managing my own retirement account, things of that nature. And thought I would share some of my stock market views over what I see as a candid look at the stock market. I'm not a stock market analyst, obviously, as you can tell. But I love the stock market. I've been doing it since 1990, 92, somewhere around there. And now at my age, my goal is to create an income. We get Social Security, just started getting that, by the way. And I like taking a candid look at the stock market to make sense out of all this confusion. Because especially starting last week, and I'm going to talk about financials today. They've been clobbered. You know why? I'm sure you all heard about Silicon Valley Bank, Signature Bank, and First Republic. Signature and First Republic being around New York. Silicon Valley is a California-based bank. And the problem I see with that Silicon Valley, they had a lot of problems to start with, but they had a run on their deposits. That would be like somebody like me and you want to go get money out of our bank. Can you imagine millions of people doing that at the same time? And you can just click on your phone nowadays. You don't have to go to the bank. Everything's electronic. And Silicon Valley Bank was funded by venture capitalists. The venture capitalists could be a person, an individual, a group, a company that put money into this bank. This bank catered to venture capitalists. Venture capitalists finance companies, give them the backing, the financial backing, things of that, to hopefully get their company to become public. And that's how they make money. Let's say company X is private, and we want to take company X public, as in public to the stock market, where people buy shares and we become owners of this company, and we want it to do well so we can make some money. The venture capitalists think that way too, but they talk about millions and millions of dollars and billions of dollars. So they take this company X and they hope that one day it'll become an IPO. And an IPO stands for initial public offering. That's taking a private company public on the stock market. And they price it where it's 50 million shares they're going to do, or whatever they price it at. It opens up on the stock market at the first day of trading. Sometimes it takes it to 10 or 11 o'clock to open up, sometimes 2 or 3 o'clock in the afternoon, depending on how many orders and sales and all this. So it goes public and they make a lot of money. And the venture capitalists, they make a lot of money because they've invested in it, so now they're getting the reap of their risk of putting the money in. Well, the problem is this year, there's not been any IPOs to speak of. It's been that way for several months now. And you got all this money out there, and the companies that are private are not going to IPO because the market sucks, basically. So now people start wanting to get their money out of this Silicon Valley Bank, okay? So when they get the money out, and all of a sudden there's a run, you got, I don't know, thousands, million, who knows how many it was. You can just push a button on your phone to transfer money from one account to the other. They didn't have enough money to take care of that. Why didn't they have enough money if people invested billions and billions of dollars into it? Well, they took the approach of buying U.S. treasuries and bonds and probably some other things, maybe mortgage-backed securities. I don't know. I know U.S. treasuries, I believe, for sure, bonds, a couple of years ago. And the thing about that is, U.S. treasuries are guaranteed money if you hold it till it matures. They can buy a 3-month U.S. treasury. You can buy a 6-month, year, 2 year, 5, 10. I'm not sure how many years Silicon Valley Bank had invested before it became mature. You can buy a U.S. treasury bond. We'll use that as an example. It costs $1,000 to buy a bond. So if you buy 10 bonds, it costs you $10,000, right? So back a couple of years ago, when interest rates were zero, and your local savings bank, or where you have a savings account, gave you 0.01% interest. I put $30,000 in when my wife died a couple of years ago, and it was earning $2 a month, $24 a year. Give me a break, $2 a month and $24 a year. Hey, that's not gonna work. But U.S. Treasury was giving 0.5%, 3/4. I don't know what they were doing back then. A couple of years ago, whatever the Treasury rate was. It was better than 0.01. I guarantee you that. So Silicon Valley Bank invests, I don't know, millions, billions. I don't know exactly. I don't have the facts. Just looking at it candidly. They put a large amount of money in U.S. Treasuries that were a year or 2 years before they could mature, right? So you're guaranteed to get your money plus some interest and all whatnot in a couple of years. But the problem was the Federal Reserve, a lot of people call them FDIC. You ever heard of seeing the bank say your deposits are insured by the FDIC for $250,000? If you got $10 million in there, only $250,000 of that $10 million is secure. The rest of it, you're up the creek, no paddle. You know what I mean? So that's not good for Silicon Valley when everybody wants to take their money out. So another way to look at this is bonds. You buy them at $1,000 increments. When you look at a price of how much it costs, they use hundreds. So instead of one bond being 1,000, if you're looking at it, you have to think in your mind it's 1,000. But if you get a price quote on it, it may be $100, which would be the price of equal to 1,000. So a bond back in the couple of years ago, it might have been $99.70, $99.75, $99.50. I don't know what the exact price was. I just know it was high. So the yield on that, let's say it's $99.50. You know, and you're going to get $100, or in this case, if you do $950, you're going to get 1,000 back. So you're going to make $50 if you hold it to maturity. So if you got 10 of them, that $50 will be worth $500 when they mature. That's great. You're guaranteed to get that. But if it's 2 years out, it's still going to be that price. You're going to get, you know, your $1,000 back, or, you know, if you bought 1 or 10, you get 10,000 back. But the thing is, with this bank, they couldn't hold them to maturity. Because, as you know, the federal government's raising interest rates, hurting us all. You look at your credit card interest rate, probably 25%, 29%, who knows? I pay mine off every month. I'm not paying that 29% interest on it. But because all the depositors, the Silicon Valley Bank, started taking a run on their money, like I said, this kid on the phone, go to the account, transfer money out, you know, electronically so fast. They didn't have enough money to cover the depositors taking their money out. So what do? They had to sell some of their bonds, say U.S. Treasuries or whatever. The thing about that is, if you hold it to maturity, you're not going to lose any money. But if you have to sell it before they mature responsibly, you could lose money. In this case, they did. Because when the federal government raised interest rates, a lot of times some Treasury notes, they go up in yield, the percent. Look at yield as a percent on your savings account that you earn per year. So if you get a 5% yield on a 6-month Treasury bond, I think it's in the 4s right now, and it goes up and down. It's crazy lately. But if you do that, you're doing good. But with Silicon Valley Bank, if they paid, let's just use this as an example, just not exactly, I'm not saying this is what they pay for, but this is an example to show you why they probably lost money. If they bought them for $99.50, and they're going to get $100, or really, you know, it's 1,000, so look at it in thousands, but we'll keep it simple. We'll use the $100 one. They bought it for $99.50, and the interest rates went up, and the yields went up. That means the price of the bond went down. So, which seems kind of strange. But the reason that's easily explained is $99.50 to $100 is only 50 cents. It doesn't take much interest to get you from $99.50 to $100. But if it drops to, say, $98.20 or $98.50, now you got a dollar, and for $98.50 you got $1.50 to go to get to $100. So the interest is higher because you still get that $100. So that's what happened to Silicon Valley Bank. They bought it when the interest rate was 0.01. And maybe U.S. Treasuries were maybe 0.5%, or 0.75%. That's a whole lot better than 0.01. You get $2 for every $30,000 you have every month. That sucks. But because they were locked into long terms, maybe if they bought it, let's say, for example, just using this as an example, they bought it for $99.50. Let's say they got $1 million worth at $99.50. Well, let's say they have to sell it now. It's only $98.50 is what they can get for it, because they got to sell it to cover their depositors taking the money out of the bank. So that's $1 less than what they paid for it. So if you got $1 million, you just lost $1 million because you got to sell it to cover your depositors taking money out, even though it hasn't matured yet. But you can't do that, but you lose money. So that's what happened there. And the FDIC, or the Federal Deposit Insurance Corps, they shut the bank down in the middle of the day, no less. I've never seen that happen. Shut a whole bank down in the middle of the day. And then after that happened, we had Signature Bank out of New York who had the same problem. I guess they took over that too. And then First Republic was starting to have a bank in New York. They started having problems. They did go under because about, 4, 5, 6, maybe 10 banks put in money to unsecured deposits. A total of $30 billion they put in First Republic Bank to keep it from failing or being bought out by another bank. And that's great. So anyway, it's been a confusing week. And this started last week and was continued into this week after the great Janet Yellen yesterday spoke at the same time Jerome Powell spoke. Well, I'll get back to that later. But what I want to do is my candid look at the stock market. I'm not, like I said, I'm not a stock market analyst. I do it for fun. Actually, it's not fun anymore because I retired, so I try to make money. But my goal is, being at 62, you want to have dividend income for my age. You get Social Security when you get your retirement, blah, blah, blah. But I've got my own pension plan. I manage it myself. Same thing with my 401k. So my goal is to have dividend stocks. And since we're talking about financials this week, I'm going to talk about a bank that I actually own, disclosure, by the way. And that's called TFC, which used to be Branch Banking Trust Company. They merged together with another company. And now it's called Truist Financial. And it's a Southeastern bank. I am from North Carolina, a little country boy, and just trying to make it. So I own that stock. And just for an example, when that bank crashed, Silicon Valley I'm referring to, TFC stock was pretty close to $47, $48, okay? And then within just a matter of days, the stock plummeted. Basically we'll go to March 17th, that's just recently, to less than $30.50. One time it was down to 29. So I had bought some of this stock at $32.50, okay? And then it kept going down, so I bought some more at $30.50. So I bought the same amount of shares at $32.50 as I did $30.50. So if you buy 500 at one and 500 at other, the dollar cancels out so far as the cost basis. And anyway, the cost basis is $31.50. So my point is, even though it went down, I bought some more, and it lowers my cost basis to $31.50. And currently it's at after hours trading at the moment. This is what, March 23rd, Thursday. So it's up 10 cents at $32.67. That's good. Now I bought some at $32.50, some at $30.50. So my overall cost is $31.50. So I got $1.17 profit. That's great. I'll take that. It also pays a nice dividend. As I just told you, I like to talk about dividends. That dividend is when you're retired. So it pays a dividend of 52 cents a share. And that's a 6.4% yield. That's pretty daggone good. 6.4%. Look at that as a savings account. 6.4% a year. And I was getting 0.01 on my $30,000 that I had in an IRA, and they put an interest on it. It was $2 a month, so $24 a year. So if you got 1,000 shares of TFC at 52 cents, they pay that 4 times a year, quarterly. So 1,000 times 52 cents, $520. That's right. And in 6 months, that $520 turns into $1,040. And you get that again. So it's actually $1.08, so it's actually a little more than that. So you get 52 cents times 4, so 4 times 52, that's $2.08. So times 1,000, $2,080 if you have 1,000 shares. $2,080 interest. If you have 1,000 shares and my cost base is $31.50, that's $31,500. Okay, $31,500. But I'm going to earn $2,080 on a 1 year. I don't care if the stock goes up or down, as long as I get to pay that dividend. That makes sense to everybody? And remember, I just told you I had $30,000 in an IRA a couple years ago, earning $2 a month, $30,000. It's a total of $24. Now I got $31,000 in BB&T, or excuse me, it's TFC now. earning over $2,000 a year as opposed to $24 a year. That's how you make some money. You had to get away from stocks that go up and down, and you panic and you sell them and you do all this and that. But my whole point is, not just talking about TFC, because I do own that, so that's a disclosure, obviously, because I do own it. I'm not trying to get y'all to buy the stock. I'm just using that as an example because I own it. I'm familiar with it, and it's a Southeastern United States regional bank. What made me buy it was, if you remember First Republic Bank, 10 banks got together and put in $30 billion, okay? 5 banks put in $1 billion apiece, that's $5 billion. 2 banks put in $2.5 billion, so that's another $5 billion, so that's $10 billion. And then some more banks put in $5 billion apiece to get it to $30 billion they put in unsecured deposits into First Republic. So that's why it didn't go under receivership by the federal government. And I got looking at it, and TFC was one of those banks that put in $1 billion. So taking a candid look, and forget about all the analysts and is it doing this and that and on and on and on and on. If TFC is putting $1 billion into this regional bank or First Republic unsecured, then TFC must be doing pretty good. Don't that mean logic? Don't that seem logical? No matter what the analysts say, if you're a bank that's about to fail, you're not going to put $1 billion in another bank, right? I wouldn't. So that's what made me buy it in the last week or so. And like I said, I bought some at $32.50 and some at $30.50. But I'm not just touting TFC. Other banks, PNC, which is a regional bank, big banks like Citigroup, JP Morgan, they're just big banks. And I'm not exactly sure which one of the big banks. I'd have to go back and look at it. But there were some of those big banks that put $5 billion in. They're probably in pretty good shape too. So, if you like bank stocks, financials are taking a hit this week unnecessarily. It's panic, it's fear from the market that everybody in America is going to go run to their bank and take their money out. No, that's not going to happen. It's not going to happen. And so anyway, any of those banks are good. If you like Wells Fargo, Bank of America, they're all good, in my opinion. That's just my opinion. And I'll talk about TFC because I own it. So after it went, this week, it's been a crazy week. Tuesday, after I had bought these couple of things, after I bought these financials, I had talked about, I've talked about them being unnecessary down. TFC was up 9% one day on Tuesday, up 9%. Then we had Wednesday, March 22nd, debacle for some reason. I don't know what it is. People are always, it was the Fed that had the MOC meeting Wednesday. And the stock market was doing pretty good. Jerome Powell comes out and says, yeah, we're going to backstop, which as far as I'm concerned is like a bailout. We're going to backstop all the banks. If they have a run on deposits, we think it's going to be contagious, or contagions as they like to put it. Contagion meaning that they think this bank's going to cause other banks to go under. They're going to step in and backstop it. Okay, that's what Jerome Powell said after the Fed raised interest rates again on Wednesday at the FMOC meeting. Jerome Powell is the head of the FMOC. He's the head guy when you see doing the Q&A after the meeting and the results they announce of what they're going to do. So, yeah, it was up 200 points. Okay, so he's doing questions and answers. And lo and behold, old Janet Yellen. You guys know Janet Yellen? She's actually the U.S. Secretary of Treasury. That's great. She used to be what Jerome Powell is now. I think she used to be in the FDIC. Chairman, I believe, or chairwoman in this case. She goes on there, talks at the same time Jerome Powell's going to Congress, saying that they asked her the same question that people were asking Jerome about backstopping banks. It's just a fancy word for bailout as far as I'm concerned. That's my opinion. So anyway, what she said, Jerome Powell said they were going to backstop all of them if it seemed to be causing a contagion. They would take care of everything. But Janet goes on there and says, got the same question. We'll backstop selective few if we see a contagion is present. So that's kind of like Jerome Powell saying, it's going to be sunny and 84 degrees today. And at the same time, Janet Yellen saying, it's going to be 30 degrees a day and cold. We're going to have a foot of snow on the ground. It's exactly opposite of what Jerome Powell was talking about. So after she said that, the stock market went down big time. It was running around 200 plus. after Jerome Powell spoke. And everything was leveling out somewhere, maybe dropped down to maybe 100. But then good old Janet, after she made her statement, selective banks we might backstop if they have a contagion. Okay. So the stock market didn't like that. So it sold off. Everything's selling like crazy. Financials, everything. And the stock market went to being up plus 100 or so. In 35, 45 minutes, down 535 points. And guess what took the biggest hit? You guessed it, financials. TFC being one of them. And all the other banks. So that's okay. And anyway, I think, like I said, today is 32.67, so we're good. And speaking of financials, I like to take stocks. I like to buy stocks that are unnecessarily brought down. I also like to buy stocks that are earning money. Don't buy a stock that's not earning money. And you can look at that. You go to any of your little brokerage websites, whatever you got. There's something called P/E. That's price to earnings. Don't buy that if it's negative, unless there's something, they're making good money. Another company I like is Prudential Financial, which is also in the financial business, believe it or not, hence the name Prudential Financial. But they do other stuff like insurance. And it depends on how many insurance claims they have. They go up and down with the banks. Although I usually like to buy stocks with earnings per share. Prudential's kind of operating at a little bit of loss of money. They operate per share. But I still like Prudential. They pay a really good dividend. And I bought some at $77. I was going to buy some today, but when it got down to a 52-week low today of 76.53, but I didn't get a chance to buy it because I was doing something else. By the time I got back, it was already back up. But it has a dividend yield of 6.35%. I like that, 6.35, which is $1.25 a quarter. Hence, $5 a year. $1.25 times 4. It's $5 a year. So if you got 1,000 shares of that, you're gonna get $5,000. That's not bad. As long as they keep the dividend. They cut the dividend, I would get rid of it. But that stock's been unnecessarily hit itself. Back on March the 3rd, which is 20 days ago, days of 23rd, their stock price was $99. And today, it ended it at $77.23. So $22 almost down in just a matter of 20 days. And I think, this is my opinion, sold unnecessarily. Unnecessarily. If you look at some of the analyst ratings, there's I think there's one that's got sell on it. There's one that's got a buy on it. There's several that have hold, equal weight, neutral. So nothing bad. So I like that stock. So like I said, I'm into trying to just give you a candid look at stocks that pay good dividends. Prudential's one of them. TFC is another, since we're talking about financials. And I see, I do own Prudential. So, and Wells Fargo, it's good stock. I do not own Wells Fargo, but it pays a dividend of 30 cents a share. So that's 3.23. I like that. That's pretty good. It does have an earnings per share of $3.14. And just like the rest of the banks, on March the 6th, it was a $46.63 stock. Today, $36. Yeah, $10 down in 20 days. No, there's nothing wrong with Wells Fargo. Really? It's just fear is what's driving this market. Negative sentiment. Anytime you got a lot of negative sentiment, people that just don't do it. And all the banks, you can look at PNC, which is a bank. And we'll go back to the same date on 3/6. The stock was $152. $152, 68 cents to be exact. Today, it's $122. $30 different. A $30 drop in 20 days. Or actually, in this case, 17 days, because we're looking at March the 6th. And you got 1, 2, 3 analysts recommended a buy. You got one that says avoid the whole thing completely, and a couple on hold, and a couple that are underweight, which means they got some of it, they don't want a lot of it. But hey, this stock earns $13.85 a share. It's price to earnings, $13.85. And its quarterly dividend is $1.50. So that's $6 a year, as long as they keep the dividend. So my whole point is, buy good stocks. Do your research. If you buy a good stock, it's going to do well, regardless of its financial. We're just talking about financials this week, so maybe next week we'll talk about something else. And keep your head above the water. You can listen to all your news shows, CNBC, Bloomberg. I'm just naming a few. There's plenty of you to watch. And what confuses me, I have a news anchor or the host of that particular segment ask a question about what do you think the Fed's going to do this Wednesday, which was yesterday. And they talked about this all week long, Monday, Tuesday, even Wednesday, all the way up to when the Fed. How much do you think they're going to raise it? How much do you think they're going to raise it? You know, one person said, oh, it might be 0. Next person said, oh, a quarter basis point. Next person, 50. Another person said, well, if they raise it, it could be a bad sign to the market. If they do, you have 30 people give you this different answer for the same question. And it's all an opinion, just like me. I'm just giving you my opinion. But I'm trying to give you a candid look without all the technicality. There's two types of people. There's chart people, technical people. You look at a chart that's 10 years. Somebody showed me a 10-year chart. So look at this, what it's done in the past 10 years. I don't give a rat's ass what it done 10 years ago. The economy's not the same. It's not the same. You can give me a technical chart like head and shoulders, or this means that, or speaking of Prudential, the death cross. Well, hey, that's terrible. Maybe so. That must be a good opportunity for me to buy. If you think it's a death cross, what's a death cross? Well, it's usually a mark below, I believe, the 50-day moving average, and it's going crashing, and I don't know. It's that's a technical person that sees that. So I don't know. Charts are good. They do tell. History does repeat itself. So just because they have a death cross, maybe it's a death cross because all the other financials are going down. I'm just saying. But it has since it actually came out on the news that Prudential's formed a death cross. That sounds terrible, don't it? Like it's not going to go to 0. It's not. If it does, I'll just admit to that mistake. I don't think it's going to 0. And anyway, in after hours, Prudential's up 30 cents today. So maybe it'll be below 77 more. I'll buy some more. They didn't cut their dividend. Right? $1.25 a piece, share. I think if you got 1,000 shares of that, $5,000 a year. Of course, a pound of shares would cost you $77,000, but you're not going to be able to put $77,000 in a bank and earn $5,000. I guarantee you that. So anyway, that's my take on financials for this week. We'll get involved in something probably next week. Maybe we'll talk about some good dividends, because what I'm going to talk about generally, besides regular market news and being candid about what I see, I'm going to, I'll throw out some stocks I like. Some of them I own, some of them I don't. But my goal is to help those who can't understand all the technical garbage that you hear on the news. And basically, I want to know if it's a good stock or a bad stock. And you think that'd be an easy question, but then if you get somebody who's technical, they got to go through 5,000 things about the company. Obviously, earnings per share would be important. Now, if a company's losing money, I wouldn't think that'd be a good stock to have. If it doesn't pay a dividend at my age, I don't want the stock, because I want a stock that's paying a dividend, because I need income, because I'm retired. And I need to get to Social Security, but I want more than just Social Security. I want to be able to do things I want to do, which I have been able so far. So my goal is, and I'm already achieved that. I've been retired for 3 or 4 months now, but I've got dividends up around 9,000 now, and interest rates in a money market account, plus treasuries, U.S. treasuries, I buy them 3 months at a time. not going to get locked into something a long time, and I'd rather put it in the stock market. Because the stock market's going up and treasuries are going down, so I do 3 months at a time. But with all that said, the dividends and interest income from the money market and interest from the U.S. bonds maturing, I'm close to $15,000 a year now. Like I said, I'm a small investor. I'm a retail investor. I'm not a hedge fund manager. Obviously, you can tell the way I look when I'm like long ass hair and old. That's okay. I enjoy life. So you guys have a great weekend. And as things change, I'll come back. I just enjoy talking about stocks and different things. And like I said, this week was financials, the FMOC meeting. Next week, maybe we'll talk about something called aristocrats and champions. These are stocks that get put into different groups based on how they pay a dividend. Believe it or not, you got to be an aristocrat. You got to increase your dividend over the last 25 years. And champions a little bit different, but we'll go into that. And that's the public knowledge. You can just go on the website and punch that in, and you can choose your own companies you want to pay a lot of dividends. So hope you guys have a great weekend. Appreciate you listening. And again, we'll see you again next week. Have a great one.